In this week's update, a modest pullback for the S&P 500 is the likely outcome, but it's all about expectations. Precious metals now set for a sharp decline, and more in the educational series. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. Okay, let's start with the normal overall market perspective. What are the key expectation variables? There are a lot of things that the market is concerned about at the moment. That is always the case, but I guess right now we've probably got more than our usual share. So what are the key ones? And to me, there are three main things. There are numerous others, but these are the main ones. The market is just completely obsessed with the Fed tapering their bond buying program, which is a bit of a red herring anyway because of some other things that are going on in financial markets. They're effectively withdrawing a lot of the liquidity, or a lot of the liquidity that's being injected into the market by the Fed is actually being withdrawn in other ways. So there's not actually the level of stimulus in the system that a lot of people think there is. But that is certainly occupying most people's minds at the moment, and the market seems as though it's going to react quite negatively to that eventual outcome. My view is, as always, the market has probably priced a lot of these things in already. So I suspect a level of tapering is already priced into the market. The second thing, obviously, is inflation, which is a key one and is related to the first one as well. And you know that debate's been raging now for most of the last decade since quantitative easing really got started in a major way in 2010. And the third one that's now becoming a little bit more apparent is global growth. It was looking very strong, but it would appear to be reducing quite quickly. So there's a real question mark now over just how much global growth is going to be sustained. Now, this is a bit of a statement of the obvious, but sometimes we forget the obvious until it's pointed out. The market doesn't price on the current reality. So the market is not pricing what the Fed is doing now, or what inflation is right now, or what global growth is right now. It's pricing on the expectations around what it's going to be in 6, 9, 12 months' time. And that, of course, involves assumptions. And as soon as you start making assumptions, then there's a degree of vagueness, I guess, around how accurate they are. So at the moment, it's a big guessing game, and that's why we see sentiment go backwards and forwards from positive to negative, and the market just follows in the short term. It's very difficult to follow in the short term, and that's why you've got to be very clear about your medium and longer term objectives. All right, if we look at the fundamentals of where we sit at the moment, not only in the US market in particular, but also globally, there's been tremendous earnings because of all the stimulus and the opening up and all that sort of thing. But global growth would appear now to be slowing. And I think there's also enough evidence, and you've got to get away from the headline inflation numbers because that they can be manipulated to say what it is that central banks want them to say. But when you look at some of the actual manufacturing cost rises and wage increases that are starting to come through the system, I think there's no question that inflation is rising. Whether it's rising to a point that's going to be a problem is, the whole debate. But what we've got is this very uncomfortable combination of global growth that's slowing and inflation that's rising. And, you want to hope that we don't get to a point of stagflation, which is what central banks are absolutely paranoid about avoiding. And, they will do everything within their power to prevent getting to that situation. And if they've got to go back to turning all of the stimulus taps on again and perhaps ignoring inflation for a while longer, then that's what they're going to do. But, we're heading into a very uncertain future, I guess, is the bottom line. So that's the fundamentals. But the price is going to move well ahead of the fundamentals. So if we look at the technicals, I don't see anything in the charts that suggests other than a short-term pullback in the major stock indices. There's predictions out there that this is a major top, and who knows, it might turn out to be. But I think at the moment that outcome is pretty unlikely. But I think we are at a seasonal point where a short-term pullback is quite likely. So I think that would be my base case for the next 6 weeks or so. It's really important, though, not to be looking at indices, to be looking at where the actual individual sector money flows are going. And so relative strengths to show you where the money is actually flowing is really important. And I guess we're in a time now where so many things are quite unpredictable, and that's probably the only predictable thing that we've got out there, is that there's just so many unknowns. Okay, turning to American stocks. Actually, before I do that, let's just look at a couple of other things. So we'll just quick eyeball on Bitcoin. We have obviously busted out of this range. Little false breakdown, which everybody jumped all over in July, and then since then we've just rapidly gone back up from 30,000 to getting very close to 50,000 now. So the price of Bitcoin has confounded everybody, I must say, and that's probably all I want to say about that. Now, if we look at some of these really important spreads, I'll come back to the gold ones. I'll come back to the gold and silver ones when I do that section. These are two key ones that I look at almost every week, and this is Russell 1000 growth versus 1000 value, and we're generally positive. So growth is being given more money flows than value is, but there's probably not a lot in it, and it may well continue in this vein for some time, where it gets down to just picking individual stocks, and whether they're growth stocks rebounding, whether they're value stocks that are rebounding because of their extreme valuation attractiveness, or whether it's just growth stocks that have got a tremendous outlook, then we might see money going into both parts of the market. So that one hasn't changed very much in the last few weeks. Consumer discretionary versus consumer staples, it has fallen, and a lot of that is because of Amazon. Amazon is such a big weighting in consumer discretionary that it has an outsized effect. And Amazon's quarterly report was one of the few that left a bit to be desired. And so I don't know how much credence I want to place in this chart falling as much as it has in recent weeks, because it's really heavily just down to one stock, and that could be just a one-off set of numbers and a one-off market reaction. So I'm not reading a great deal into that, but I just observe that consumer discretionary is certainly not as buoyant as it was. Okay, let's look at American stocks. So the S&P fell by 0.6% for the week, and it's very obvious that the market has clearly turned defensive in nature. There's little question about that when you look at the sectors that are leading. Utilities, real estate, and healthcare are certainly up there. So a much more defensive tone about the market at the moment. Healthcare was probably the best of the week, and we've seen some very positive runs in stocks like Johnson & Johnson and Pfizer and the like. Also, technology had a pretty good week as well. Now, as everyone knows, I've been talking about this for weeks and weeks. Seasonality certainly plays its part, and from now until the end of September is a period that if we are going to get some sort of pullback or correction, then now's the time it's more likely to happen. It's not a prediction, it's just an observation of history. Part of that is because we've just come out of the end of earnings season, so all the news is out there. there's been a certain degree of buy the rumour, sell the fact. And, it's just the way that it works. And seasonally, this is a bit of a weaker time of the year anyway. So that's all sort of playing its part. But we are seeing the small caps. So Russell 2000, IWM is the ETF that reflects the Russell 2000. And that's really looking fairly weak. And that collapse in breadth is the thing that concerns me more than anything. We've got now the S&P and the Nasdaq being held up by a rapidly decreasing number of large stocks, and that's never a healthy situation. So now, look, it might resolve itself quite calmly, but that's the direction that we're heading, and it's not one that I'm totally comfortable with in the short term. The US dollar broke upwards, and that certainly got ramifications for commodity prices. Finished at 93.5. The 10-year yield went up to just above 1.3, but eased back a little to 1.26. The VIX spiked up to 22, and we had a bit of a short, sharp sell-off at the start of the week, but then came back down again and finished at 18.5. So let's take a look at some key sectors. So if we look at the healthcare sector, you can see it's had a very strong week. We're significantly above the 20-day moving average now. It's looking very, very bullish. You can see the 3 moving averages are flaring out. The gaps between them are getting wider. That's indicating an acceleration of the trend. And you can see down here, we've got clearly the healthcare sector is under significant institutional accumulation. So things looking very, very positive. So if you want your money working in the short term, then it's hard to go past healthcare. Technology also doing pretty well, but again, a good part of this is because of strength in Microsoft, Facebook, and to a degree Apple, although Apple's starting to look as though it might be getting a little tired on the upside. And Amazon doesn't come into this. It goes into the consumer discretionary sector. But also Google, I think, has done reasonably well. So XLK at the index level, looks good, but I'm certainly seeing a contraction of the breadth of that advance. But look, these comments are all short term. I don't see any change, frankly, to the long term with these growth stocks that are part of the mega trends. Just to look at a few of the other sectors, XLF, we got a very minor breakout the week before last, but the rise in the 10-year yield didn't go on with it, and so we've seen a little bit of a pullback in the finance sector, but it's really just, I think, gathering momentum before it has another crack at the breakout, because in a rising inflation environment, that's a positive for banks. And this is consumer discretionary. So we did get a minor breakout. We then tracked along sideways, but then it's fallen with the result from Amazon. But look, it may well have turned around on Friday night. So this is all just short-term, backwards and forwards kind of price action, which doesn't tend to mean a lot for most investors. So if we look at the S&P, you can see we had quite a sharp dip on Tuesday and Wednesday. We then gapped down on Thursday, traded up, and then we got some very good follow-through on Friday. But again, it's narrow leadership. So I wouldn't be at all surprised if we've seen the peak in the S&P for a little bit, maybe 6 to 8 weeks, something of that order. And that we might now get some sort of sideways move or some sort of mild downside. And I'm a great believer in just respecting what it is that the market is showing you. And at the moment, the market is showing us that pullbacks to the 50-day moving average, the blue line, or briefly below is okay. And that's about it. So it may well be that somewhere around this 43.20 mark, perhaps down to 42.50, something of that order. So we might come down and test these lows here. Could be possible, but look, I'm not expecting anything terribly dramatic in the S&P, unless of course something blows up around the world that causes a bit of a panic sell-off. But we can't trade and invest on the basis of what might happen. Now, if we look at the Russell 2000, you can see we're now back down towards the bottom of that band of support. So the small caps have clearly lost all their upward momentum. We've now got the 50-day moving average is now below the 200 and is pointing down, and the value of the index is below the 50-day moving average. So clearly you'd have to say we are now in some sort of downtrend, even though we haven't broken the support. But if we do see IWM break support at 207, then that'll be significant, and that's likely to bring out some sort of additional selling just on technical grounds. So 207 on IWM is a pretty key level to keep an eye on. US dollar index. We had a look over the top of this prior peak. So the prior peak was formed at the end of March. We had a peak over the top on Thursday. It was then looking fairly strong on Friday as well, and we actually got up to 93.73. Backed off a little bit, but at the moment you'd have to say we've got higher highs, higher lows. We've got an uptrend in the US dollar index. The Australian dollar, though, has collapsed quite sharply, and it's collapsed by a lot more than the US dollar has gone up. And this is partly due to the iron ore price. I think it's quite possibly partly due to other economic reasons with the Australian economy, which of course is now in heavy lockdown, and that has to be taking some sort of economic toll on the Australian economy. So the Australian dollar finished down at under 71. So we're almost down to the lows. If we pan back and look at where we previously had found support, it's around 70.25. So that will be a likely area of pause. But if that breaks, then frankly, we could be looking at the Australian dollar well down into the mid-60s. But part of that will be dependent on what happens to the iron ore price. Turning now to Aussie Stocks, 70.94, as I showed you. Our index fell by 2.2% for the week. Particularly on Thursday and Friday, we saw a lot of profit taking in battery materials. It was sharp. And if you are heavy in battery materials stocks, then it would have been uncomfortable. But look, it's pretty normal when you go through the actual chart patterns and get away from looking at the red on your screen. The chart patterns don't look anything scary to me at all. This is just normal. The prices had advanced very, very quickly, in some cases almost exponentially, and they're going to come back. It just, it happens all the time. So you just need a game plan that can deal with that sort of level of volatility. Resources were the main drag on the Australian market, as we'll see. So we'll look, first of all, there's the ASX 200, but it's still advancing quite nicely, still holding above the 50-day. But look, iron ore stocks got smashed with the iron ore price, and also the reaction to BHP's announced intention to delist in London. That didn't go down all that well in London, and there was certainly the appearance of a lot of selling of BHP, so that didn't help. But energy has also broken down. I'll have more to say about that. So our energy sector fell quite sharply, and again part of that was Woodside with this petroleum deal with BHP. So they were the main drags on the index. Finance came off a little bit, but healthcare went up. So healthcare was really the star of the week, as it was in America. Turning now to precious metals. Gold was flat at 1781, but silver has broken down quite significantly, and silver is underperforming gold. And if you think back 12 months ago, I was just constantly talking about how silver was outperforming gold. It wasn't falling as much as gold was, and that was a good sign for the market. We've now seen silver break down quite significantly, so I think there is potentially some major moves brewing in the precious metal space. Not so much because of silver's breakdown, but I'll come to that in a minute. So the metals themselves are holding reasonably okay, but it's the stock weakness is the really poor sign. And anyone that's watched these videos over the years knows that, particularly in the precious metals market, I place a huge amount of emphasis on the fact that stocks tend to lead the underlying metals in both directions. Sometimes that lead is by several days, sometimes it's by several weeks, but it's very rare that the stocks don't start to move in one direction before the metals do. And what we're seeing is stocks are breaking down very badly. So I think there's a fall coming in the metals. That is the probability, based on just years and years of observing this market and observing the fact that the mining stocks move before the metal does. Now, the US dollar going up is important, and we've got higher highs and higher lows, so therefore you've got to say that the odds favour more strength in the US dollar. That could turn around, but at the moment, that is what it is. It's going up, and so that's not helping. That's not going to help the gold price either. But it's really GDX, GDXJ, the likelihood of a significant fall in the market that'll feed on itself is becoming stronger in my view. So let's take a look at that. So we'll start first of all with just the daily chart of gold, and you can see we had a very sharp sell-off a couple of weeks ago in early August. We got down to basically a triple bottom, and so the market rebounded. Again, that's normal, just the normal back and forth in the market. And it looks now, you can see how these candle ranges have rapidly got smaller. They're quite indecisive. You can see we're pretty much opening and closing at a similar level, and we just seem to be rolling over. So we've managed to make it back to the 20-day and the 50-day moving averages. So all the moving averages are now rolled over. They're all pointing down, and they're all aligned in a downward direction, and the price is below all of them. So, I think the odds certainly favour the gold price rolling over, and it's just a matter of how far down it beg your pardon, it goes. We're obviously going to have support around the 1590 to 1600 area, but if that level were to break, if this really were to get a significant hurry up to the downside, then we could be looking down in the mid 1500s. Now that flies in the face of what you'd expect with inflation rising, but there's a lot of cross currents happening. We've got things that are driving gold in one direction and other factors that are driving it in the other. There's the weekly chart. Doesn't really give us too much more information, but if we look at silver, you can see silver is now broken down, and clearly we're in downtrend. We're in a sharper downtrend. You can see the price is further below the 20 and the 50. All the moving averages are rolled over. We've broken key support, so silver is not looking all that terrific either. And if we have a look at the spreads, So this is the ratio between US dollar gold and US dollar silver. This is what happened leading into March of 2020. We saw a massive spike where silver was sold off far more sharply than gold was sold off. That's what that ratio says. And then once we got past that peak, we came back to normality, which is somewhere around about the 50 to 1 ratio mark. We didn't quite get down there, but we didn't get too far off. But you can see now that line, that ratio is rising again quite quickly. So that's telling you that gold is outperforming silver. Even though gold is not doing anything, it's because silver is breaking down. And the other one I wanted to show is this one. So this is this is GDX versus gold itself. And you can see we're now heading back down again. So that means that GDX is weaker. The mining stocks are weaker than gold, and they nearly always lead. So that's why I think we're possibly looking at some more significant downside. Because what bothers me is it's normal for the gold miners to lead gold down from a peak, but we're not at a peak. You know, we've already had a significant selling. We're $200-300 off the top in gold, and yet we're now seeing this acceleration of breakdown of the miners. That's not a good sign when we're already in decline, and that's why I think we might get a more significant and concerted move in the precious metals. Okay, so let's now look at GDX and GDXJ just to complete the story. So GDX has not yet broken these lows. We're close, but we haven't broken the lows as yet. But clearly we're in downtrend. Again, just look at the moving averages. They've rolled over. The price is below them, and it's certainly knocking on the door of support. And GDX has fallen through the week, even though gold didn't. Gold stayed steady. But it's really GDXJ where this has become more apparent. So this is the junior gold miners. And you can see how clearly this is broken down now. It's looking quite ugly. So it could well be that we get quite a sharp draft to the downside. And again, the main reason that I say that is that we're not up here. We're not up at a peak where a deterioration in gold stocks relative to metal would make more sense. This is not a particularly good sign down here. So be very, very careful in the precious metals market. But look, longer term, my position is the same as it's been for the last decade probably, and that is that long term there is a place for gold, and I would expect gold to rebound strongly at some stage, and I would expect at some point in the future we're going to see gold back above $2,000 an ounce. But in the short to medium term, it's an area where the odds favour more downside. Turning to other commodities, copper fell down to $4.08. So this is really the currency effect, and nickel was down to $8.37. There's a bit of global demand issue in the short term, which is kind of silly, really, when you think that we're going rapidly into deficit for the next decade because of the battery storage and electric vehicle tsunami that's building. But in the short term, the markets tend to look at near-term factors, and if global growth is slowing, if China's import of copper is going to reduce in the short term, then that's impacting. But also the US dollar is impacting as well. But I think this is just a short-term pullback I would expect. Beyond that, the outlook for these base metals is very good. Crude oil was down quite sharply. It is concerns over global demand. Yes, there's some currency effect in there, but we're looking at XLE, which is the main energy index in America, is clearly in downtrend. I'll just pull that chart up. Okay, so we've broken key support. So this is a very broad church, XLE. It covers all parts of the energy chain, from production through to refining and exploration. We've broken key support. A couple of other things that sort of bother me is the RSI is now down at 30, and normally in an uptrend, the RSI only pulls back to around 45 to 50-ish, and then goes back up again. So that's just reflecting a dip in an uptrend. But when the RSI gets down to 30, and we are now and we've now got a downtrend, that's another thing altogether. And you could argue that we've got a head and shoulders pattern here. So there's the left shoulder, there's the head, here's the right shoulder. And if that does prove to be the case, then a bit of a rule of thumb is that you can take the distance from here to here, which is around about $10, and you project that to the downside, which gets us down to somewhere in the mid-30s. So it's possible that the energy sector in America has still got quite a way to fall. Obviously, that will depend a bit, as it does with precious metals, on the direction of the US dollar. But at the moment, that is up. So the energy sector is not looking particularly good at all. Be very careful in that sector. There's a spot copper chart, so you can see the pullback that we've had, and the same in nickel. So that's the overview of what's been going on. Let me move now to the next chapter in this bit of an educational overview on setting up an investing game plan. Just a quick recap of last week. The key points were: I introduced the concept of holding a core and a trading approach, which just makes decision making a lot easier and a lot more productive, because you're not making emotionally charged decisions on the run. It's all pretty clear before you start. We also looked at the concepts of position sizing accordingly and how you're structured, particularly the trading portion. So that was last week. All of this will be brought together in the very near future, in the next week or so. And it'll be in much greater detail than what I'm showing in this video, with lots and lots of examples. So moving now on to the important thing of how do we take profits, both with our core position and our trading portion. With the core position, I don't have any targets for taking profit, because who knows how far something's going to run. The only time that I would adjust the size of my core position is if the size of it just becomes too outrageously big, because the price has gone up a heck of a long way. And I'm in that fortunate position with a couple of Australian stocks at the moment that have just gone up so much that the core position has become uncomfortably big, and it's forming a very large portion of my portfolio. Now, what that proportion is just very much an individual determination. In my mind, somewhere around about 15%, I start looking at it and considering the possibility of reducing the size of my core position. But look, it's a bit arbitrary. It depends on what is going on with the stock, what I think the outlook is, and the probability. It's just a bit of a checkpoint for me to at least consider the possibility. But for different people, it might be 10%. For others, it might be 20%. So, that's an individual determination. However, taking profits on the trading portion, so if you are running this approach of having a core and a trading portion, then you do need to be taking profits periodically on the trading portion. And I would also make the point that you need to find triggers. If you just do it by a gut feel, it's run far enough. You've got a nice profit, so you just sort of feel like it's the right time. That's a very unproductive way to go about it, and you're going to make a different decision on every event. So there's going to be no consistency. what you need is to find triggers, things that you can observe, and say, well, that is the trigger that I use to take profit. Because the one thing you want to do in the market, you can't be right all the time. But the one thing that you can do is you can be consistent in the way that you operate. And the more consistently that you operate, the better your results are going to be. So there's two triggers that I use, which I'll get to in just a minute. But let me just show you one example. There'll be many more of these, but just one example of why you can't really wing this and just set a profit target or do it on how you feel at the time. Now this is a stock called UWL. We broke out of a sideways consolidation in December of last year at around $1.70, and then it's just got on this wonderful smooth uptrend, holding it just above the 20-day, dipping occasionally to between the 20-day and the 50-day, but just a beautiful uptrend, nice and smooth. Now, where do you take profit arbitrarily unless you have a trigger signal? Do you take it here? Do you take it here? Do you take it when it dips below? It's unless you've got something that you can hang your hat on, then it's really just a complete arbitrary decision. And chances are one of two things will happen. You'll get out way too early and you'll leave too much money on the table. Or you won't get out at all until there's such a large correction that eventually you make an emotional decision to get out based on how much money you've lost in the last few days. Neither of those methodologies is particularly good. So there are two triggers that I use. They're pretty easy. There's a few nuances around them, and I'll cover this a lot more when I pull all this together. But there's two pretty clear triggers that you can use, and let me just give you an idea of what they look like. So here's one here. I won't even worry about talking about what stock this is because it's purely a price-driven pattern. So what I'm looking for here is where the price gets rapidly extended above the 20-day moving average, and then we get generally a gap up, which is what happened. So we opened on this day above where we'd closed the previous day. We then traded down quite sharply, but then we bounced. So that one was a little bit harder to read. But then the following day we got some concerted selling. So there was certainly evidence. And again over here, price significantly above the 20-day moving average. We opened high, we traded down, and we closed right on the lows. We completely engulfed the previous day's candle. To me, that's a very, very clear trigger signal to take some profit. Now, the following day, the price went up, and so you might have been forgiven for thinking, well, okay, it didn't work that time, but then very, very quickly, we got another reversal and the price came down. So that was a very clear trigger signal. They don't always work in your best interest. Nothing is perfect in the market, but what we're trying to do here is to do things that will be, consistently the right decision, the bulk of the time. Now, the other signal that I look for, so that one's pretty clear cut. The other signal that I look for is where we're well above the 20-day moving average. So the price has accelerated considerably, but we don't get a very big obvious reversal. But what we do get is, notice the range of the candles suddenly gets smaller and they're closing well off their highs. There's a lot of indecision. So this rapid upward momentum has been lost. And then probably on this day here, that would have been enough evidence for me to have then taken some profit on a trading portion up at this level. So they're the two triggers, and they're the only two triggers that I use to take some partial profit or full profit, depending on my plan, on the trading portion. And the more that you can have clear and unequivocal indicators, then the better you're going to be able to run this process. Now, the other part, of course, is setting stop losses, and the basic concepts that I use here. On the core portion, I don't use a stop loss. I get out of a core position because something has fundamentally changed. Either something has changed with the company, or something has changed within the company sector that would get in the way of future growth. So for me, the core portion, the stop loss, is really a fundamental one. On the trading portion, however, I set stop losses on the basis of where the price shouldn't go. So if I'm buying at the bottom of a horizontal trading range, or the bottom of an inclined trading range, then what I'm saying is the price really shouldn't go back down below where my previous entry point was. So again, it's sometimes you get false breakdowns, you get unnecessarily stopped out, but that's always going to happen. The idea here is that the bulk of the time you want to do what's in your best interests. Okay, so that's it for the educational component today. What follows, I'm going to be pulling it all together with numerous examples in a separate video. All right, so just the final thoughts to wrap it up. The US market, I think any correction that we get shouldn't worry anyone other than short-term trading positions. That's about all that the only people that are trading on the short term should be concerned about. Now, it could develop into something bigger if something raises its head, either the Fed changes their position, or inflation data suddenly kicks up, or something changes. But as it all sits at the moment, any correction in the US market, which I think is probable right now, should only be fairly mild. And I would see dips as buying opportunities, but with this really big proviso, this is far from universal. I think increasingly we're going to see more money supporting a narrower and narrower part of the market, which will be the reliable growth part of the market. And I think a lot of the stocks that have rebounded, the value stocks that have rebounded on the basis of a global reopening, have probably seen the best of it. And they've probably got fairly little upside left, and possibly some considerable downside if they're ones that are subject to technical disruption. Portfolio analyst last week, we went through my high conviction US stocks. We looked at uranium. We'd also looked at listed investment companies as well. So quite a lot of meat in last week's portfolio analyst. That's it for this week. Is my website address and email address for anyone that wants to contact me. And I'll be back with you next Sunday. Cheers.